Many of you watched a video that I made last year explaining my strategy in the market when what I try to do, which is try to buy stocks or industries is somewhere where there's a lot of bad sentiment, a lot of pessimism, something that people hate, and eventually the sentiment changes and then the stock reverses, the industry thrives, and this is what I try to sell them on extreme optimism. And Meta is an amazing example of this strategy, how sometimes we have certain stocks or industries that there's just very bad sentiment for some kind of reason, maybe TikTok or something, and people are calling them dead or it's the end or it's declining. And this is normally the time where you should be a contrarian and you should be buying such companies. And Meta went all the way down to $82 or $81 per share, and now it's sitting at $264. And the key is that whenever such stocks get priced in so pessimistic, I mean, they get priced so low, anything that's positive that could go for the company is going to cause massive moves to the upside. And this is what happens whenever you have a change in sentiment. It's very, very powerful. But Meta is not a special occasion where it's the only time that this actually happened. It has happened many times before. And in this video, I'm going to actually give you 3 industries that I believe right now have extremely bad sentiment and they are underperforming in 2023. And normally, whenever you have something that's underperforming, it tends to outperform a year or 2 from now. And if you have something that's outperforming, such as Nvidia and the AI stocks, they will most likely be the underperformers of 2024 or 2025. But first, I'm going to give you a few more examples of how this strategy actually plays out. And this is an example of Exxon Mobil, or mostly the oil stocks, in 2021. The oil stocks were going down despite oil actually was going up. It was much higher than what it was before, yet these stocks were trading at historical low valuations, because in the market we have rotations from certain assets to the other ones. This is the change in sentiment that I'm talking about. And in 2021, it was all about the EV stocks, climate change, climate kind of clean energy, all these kind of things. The oil is going to $10 or $8 per share. Some people were calling for that, and people were betting unprofitable companies like NEO and Nikola and stuff to pretty much the stratosphere, and they were selling the oil stocks. So I talked about buying the oil stocks in 2021, and I made a few videos on that, and this has caused the oil stocks to underperform despite the market going up. Well, what happened in 2022? They became the outperformers, and the sentiment has massively shifted, and all the outperformers, the EV stocks in 2021, they went down in 2022, while the oil stocks went up 50%, 100%. I had an oil stock, it went up 40% in 3 months. I sold it, then it went up 100% after I sold it. I'm not the best person in selling, but these kind of stocks performed amazingly well, and this was an example of such opportunity. Another example is actually the tech stocks in 2018, and I remember, it was all about the Fed tightening, and this is a chart of Apple. Apple has, crashed a lot in 2018, and I remember Apple because I was buying it somewhere around 16 times earnings. Apple was trading at 16 times earnings in 2018, and it bottomed around 13 times earnings. Now Apple is trading at 28.5 times earnings. This is what happens whenever you have, such bad sentiment around a certain industry. My final example that I'm going to give you is mostly again in 2021, and it was mainly around the gold mining stocks. And this is a stock that I bought. I can't share it here because it's a very small cap with very low float, and I don't want to get in trouble. I try to share stocks that I own in my own investment group, which you could check out the link in the description if you're actually interested. But this is a chart of gold, and gold went from $2,000 an ounce to around $1,640 an ounce. And there's a lot of things around it. But what did we have in 2021? We had the Bitcoin rally. People were calling Bitcoin the new gold, the Bitcoin standard, which is most likely never going to happen because governments, they like to control, whatever they own, and they can't control Bitcoin. But they were talking about the Bitcoin standard, Bitcoin is taking over, gold is dead, and all these kind of things. When I was buying back then a junior gold miner at $10 per share, and it went down 20% to $8 per share, and I was just kept buying it all the way, and now up over 45% on no those, purchases, and I still hold the stock. But even if you bought gold itself around 17 or 1600, it went up all the way up to $2,000, per ounce, or pretty close to $2,100 per ounce. So this is what happens whenever you have something that's hot, something that's kind of people are excited about. You tend to want to buy the underperformers, and then the underperformers become the outperformers. This is when you sell them, and this is what I try to do. But one of the industries I'm going to talk about in this video, and this is actually a stock I made, a video on whenever it was $156 per share here on YouTube. I try to make a video every month talking about 2 undervalued stocks to consider, and this is Avalon Bay Communities, which is a REIT, and now it's up over 20% in pretty much 2.5 months, excluding dividends. I mean, it's up a lot. And look where the stock is. It's still sitting much, much lower than it was pre-COVID. And I'm not just talking about Avalon, but pretty much all REITs are beaten down a lot, and also dividend stocks. Why are REITs beaten down a lot? Because their dividend yields are not attractive. Yes, some REITs have some problems with debt and refinancing, like MPW. I'm not talking about those, but there's a lot of companies like O Realty Income, like NNN, Triple Net, which owns convenience stores and all these kind of, things, pretty safe business model. All of them are sitting at pre-COVID levels. And this is because people can earn 5% in a pretty much short-term treasuries. Why would they go buy a REIT, take on risk, and earn 5% in a REIT if they can earn 5% in short-term treasuries? Which is why this industry is hated, and this sector is hated a lot, and people are selling them. But what's going to happen a year or two from now? Inflation is going to come down, interest rates are going to come down, short-term treasuries are not going to be yielding 5% forever. This is just the truth. But people invest like it's going to be like that forever, which is not true. Eventually, rates are going to go back to 1%, 2%, 3%, maybe 1% a year or two from now. Now, if they go to 1% and you have companies yielding 5 to 6% and REITs yielding 5 to 6%, those yields are going to get bid up, and they're going to start coming down to 2 to 3%. And these stocks can go up 30 to 40% in a year or two. This is what I try to kind of talk about. One of the industries that are really hated, in my opinion, is REITs. There's a lot of amazing opportunities in this sector if you actually dig into them. Not all of them have debt problems and refinancing and restructuring. Some of them are high quality REITs, trading lower just because people can earn a higher yield with short-term treasuries, which is not going to last forever. If you have at least a 2-year horizon, I think there's a lot of, gains to be made in the REITs kind of sector. Now, the second sector that has a lot of pessimism and it's been selling off a lot, and I made some videos on it, and this is mainly anything around retail. Even though some resilient kind of retail, stocks and industries, they are still going down. And one of those examples is Dollar General. Dollar General is down 38% year to date. Now, I made a post on Twitter, which you could follow me on Twitter if you want, and this is Dollar General's forward PE ratio. So after they revised their guidance, the company is sitting at 15 times earnings. Now, the stock in its entire time, not its entire time, pretty much since 2010, the stock has never traded below 13 times earnings. And you could see where it is right now at 15 times. It bottoms somewhere around 13 times. It rarely goes pretty much below 14 times, and now sitting at 15 times. So that would tell me that there's some pessimism in this industry. But Dollar General is not the only one. Target is down 60%. Yes, Target has its own issues, which I'm going to talk about a little bit, but it's down 16%. Something like Ulta Beauty, which, women go crazy over Ulta Beauty in the United States in terms of makeup and stuff, which is also somehow more resilient than other industries. It's down 10%. BJ's Wholesale Club, I made a video on this company, a grocery kind of mini Costco type of stock. It's down around 8%. So there's a lot of pessimism around retail. And one of the reasons why there's a lot of pessimism is because of higher labor inflation. We have a tight labor market, and labor and kind of workers in general are demanding higher and higher wages, which is increasing the SG&A expense of all those retail stocks. But again, this is not gonna last forever because the Fed is doing whatever it takes to try to get unemployment up, and they eventually going to achieve this target. And whenever they get unemployment up, whenever inflation comes down within a recession is actually bullish for these companies. Recession is bullish for Dollar General and Target because they can actually have kind of more workers available within a less tight labor market, and this would mean that they can give their employees lower and lower, wage inflation, like 2 to 3% raises instead of 5 to 6%, which I'm not saying it's bad for the worker, but it aligns with inflation of 2 to 3% instead of now they're increasing 5 to 6%, which is hurting their margins. This is one of the reasons why, those stocks are selling off, and I'm not sure when they're going to stop selling off, but I believe they're going to eventually become outperformers in 2024 or even 2025. And, the second reason is more around, theft. There's a lot of theft in the United States, but this is not going to last forever. Eventually, they're going to fix it. This is what I believe, is going to happen. Although it's getting worse, and I hope it gets, fixed soon, but not all the retailers are experiencing this. You have to, select and choose between them. But this is a second sector that I believe there's extreme bad sentiment around. There's also other retail stocks that I haven't talked about. You can dig in more in this industry and find them, for yourself. Now, the last sector that's getting beaten down a lot is mainly around, pharmaceutical companies. Something like Pfizer. Pfizer is down 24%. Year to date. AbbVie is down 15% year to date. Johnson & Johnson is down 10% year to date. Now, I'm not saying there's nothing wrong with them. AbbVie has its own issues with what happened after COVID, although I think there's a lot of pessimism with AbbVie and it's creating an opportunity. So, even something with Pfizer also, but mostly AbbVie around their Humira drug and all those things. Johnson & Johnson also has its own problems. I'm not saying these companies don't have any problems, but normally these companies tend to outperform whenever there's something to be worried about. They are more flight to safety, flight to quality type of names, which is why they actually outperformed last year. They were one of the only stocks other than the old stocks that were actually flat to positive in many of them, and now they're selling off a lot. And if you're more into the pharmaceutical spaces and pharmas, I think there's a lot of opportunities in these stocks. Maybe Pfizer and AbbVie, both of those are actually my favorite, but they will likely, keep going down because people rather bet on AIs than bet on, pharmaceutical and drugs, which again, you could take this as more of an opportunity. But my main takeaway from this video is I'm not trying to recommend certain stocks, but the biggest mistake that people make is they chase whatever is hot, whatever their friends are buying, and whatever is the most popular one, like AI. I'm not saying AI can't go higher or, but you're basically playing with fire. If you're buying AI right now, what I would be buying right now and what I am buying in my portfolio, I am buying a lot of the retailers that have good business models that a lot of people are hating. I'm buying other stocks that people are hating. They are underperforming, yes. I don't mind keep buying them. They eventually, the sentiment is going to change. They're going to become outperformers. People are going to bid them much, much higher. And this is when I sell them, and then I just do it all over again. Although I'm trying to hold the stocks for a longer period of time. But this is, my main thing of how I try to do this. So no financial advice, of course. I hope you enjoyed this video. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.